Budget and financial assistance. This week we are diving into an essential topic, budget and financial assistance. Whether you're managing a nonprofit project, running a business, or organizing an event, financial management is the backbone of success. A well-planned budget ensures that resources are used efficiently, expenses are controlled, and financial risks are minimized. Without budgeting, organizations can easily overspend, misallocate funds, or fail to meet donor expectations. In this session, I will guide you through the fundamentals of budgeting, including how to create a budget, track expenses, prepare financial reports, and maintain compliance with donor requirements. We will break everything down into practical and easy-to-understand concepts so that by the end of this week, you will feel confident in handling financial matters in any professional setting. Let's get started. What is budgeting and why is it important? Think of a budget as a financial plan, a roadmap that guides how money is allocated and spent. It's not just about listing numbers on a spreadsheet. It's about ensuring that every dollar serves a purpose. For example, imagine you are running a community health program with a budget of $50,000. Without proper budgeting, you might spend too much on medical supplies and not have enough left for staff salaries or transportation. A structured budget prevents financial mismanagement and keeps everything on track. Budgeting also helps organizations prioritize spending, making sure money is used for the most critical activities first. Avoid financial shortages, ensuring funds last throughout the entire project. Prepare for unexpected costs, setting aside money for emergencies. So a budget isn't just a list, it's a powerful financial tool that helps projects succeed. Understanding the components of a budget. A well-prepared budget has different components, each serving a specific purpose. Let's go through them one by one. 1. Direct costs. These are expenses that directly contribute to the project. They include A. Salaries for project staff, for example, paying trainers in an educational program. B. Equipment and materials, such as computers, projectors, or office supplies. C. Travel and logistics, covering transportation costs for field visits. Think of a charity running a food distribution program. Their direct costs would be the food itself, packaging materials, and delivery costs. 2. Indirect costs. These are overhead costs that aren't directly tied to one project but are still necessary for operations. Examples include A. Office rent and utilities. If a nonprofit runs multiple projects from one office, the rent is considered an indirect cost. B. Administrative salaries, the wages of employees who manage multiple projects. A common mistake in budgeting is ignoring indirect costs, which can cause financial issues later. 3. Contingency funds. A contingency fund is money set aside for unexpected expenses. No matter how well you plan, things don't always go as expected. For example, if you're organizing a fundraising gala, you might budget for catering, venue, and decorations. But what if the venue cancels at the last minute and you need to book a more expensive location? That's where your contingency fund helps. A good rule of thumb is to allocate at least 5 to 10% of your budget to contingencies. Tracking expenses and monitoring financial performance. Creating a budget is just the first step. You also need to track expenses to make sure you're sticking to it. Imagine you've been given $20,000 for a training program. You spend $10,000 in the first month, but don't track where the money went. In month 2, you realize you don't have enough left to cover salaries. This is why expense tracking is so important. Ways to track expenses. 1. Spreadsheets. Simple, manual tracking using Excel or Google Sheets. 2. Accounting software, tools like QuickBooks or Xero that automatically track expenses. 3. Expense reports, keeping receipts and documenting each transaction. If an organization doesn't track expenses, it can lead to overspending, funding shortages, and even legal trouble if they fail to report spending accurately. Financial reporting, communicating budget performance. Financial reports provide a clear picture of how money is being used. They help stakeholders make informed decisions, and they show donors and funders that their money is being spent responsibly. Here are 3 key types of financial reports. 1. Income and expense reports. These reports summarize all the money received and spent. They help organizations see if they are staying within budget. 2. Budget versus actual reports. These reports compare planned spending versus actual spending. If a project budgeted $5,000 for advertising but actually spent $8,000, this report will highlight the overspending. 3. Cash flow statements. A cash flow statement tracks when money comes in and goes out. It ensures that an organization always has enough funds available to cover expenses. For example, if a nonprofit is waiting for a $50,000 grant in December but needs to pay rent in November, they need to plan their cash flow to avoid running out of money. Donor compliance and financial accountability. Many projects rely on funding from donors. However, with funding comes responsibility. Organizations must 1. Follow donor guidelines on how money can be spent. 2. Provide detailed financial reports to show transparency. 3. Be prepared for financial audits to verify how funds were used. Failure to meet donor requirements can lead to 1. Loss of future funding. 2. Legal consequences for misuse of funds. 3. Damaged reputation that affects future partnerships. For example, if a donor provides funding specifically for education, an organization cannot use that money for office rent. If they do, they could face legal action and lose future funding opportunities. To maintain compliance, organizations should document every transaction, track spending carefully, and submit reports on time. Case study: effective budgeting in action. Let's look at a real-world example. A nonprofit was struggling with poor financial tracking. They often overspent on unnecessary items, leading to financial shortages. To solve this, they 1. Implemented QuickBooks for automated expense tracking. 2. Started holding weekly financial review meetings. 3. Trained staff on how to manage project budgets properly. The results? 1. Their budget variances decreased by 30%. 2. They improved donor trust and secured 20% more funding. 3. They eliminated unnecessary expenses, making their programs more efficient. This case study shows that good budgeting and financial management lead to better decision-making and long-term financial stability. Conclusion: why budgeting skills matter. Understanding budgeting and financial management is essential for any professional role. By mastering these skills, you will be able to A. Create effective and realistic budgets. B. Track and control expenses effectively. C. Generate clear and accurate financial reports. D. Ensure compliance with donor and financial regulations. Budgeting is not just about numbers. It's about planning, strategy, and financial discipline. By applying what you've learned this week, you will become a stronger, more responsible financial manager, whether in an organization or your personal life. That's all for this session. Now let's move on to some practical exercises to apply what we've learned.